Hi, everybody. Welcome. This is Lawrence from Trading Mastery School. And in this video, I would like to give you an introduction about the magic of combining multiple non-correlated systems. So what you see over here is our Quantum X software. And what you see over here is basically the combination of the four long-term trend following systems from my latest book, which just has been released. These results are now updated, and that makes it even more interesting because these systems are long only, trend following only. So they are designed to make money when the market go up, and they are also expected to give money back when the market starts to fall. So we see overall that there was a very good outperformance versus the benchmark with this combination. We also see that there was quite a significant drawdown. So if we take a look right now at our yearly and monthly returns over here, we see that 2023 and 2024 were exceptionally good. But then, of course, the index started to drop in 2025, and the long-term trend following systems all started to give back money, basically. They started to give back profits, and a lot of them had eventually stopped out. So we're down now minus 16%, and this is until April 28th. And remember this number. Remember this number, okay? Because this is important to understand as well. This is normal that this happens for systems that are focused on trend following only. We also see that if we're going to take a look at the exposure right now, that only 35% of our account is basically exposed. The rest is in cash already. So that is very, very normal as well, that there are times where you're fully exposed, but then the market starts to drop, positions are getting stopped out, and you're getting more and more cash levels. Now, if we go then, and by the way, I will explain every system, and of course, every system is in my book as well, where you can have a more thorough read of it. But even in this course, I will explain every system. So if we go to the next one, the mean reversion long lag. So that one consists of three different mean reversion systems. And what we see is that, there was a slight little dip over here. And currently the system for this year is down minus 3%. Therefore, it wasn't up that much in 23 and 24, so it behaves very differently. It wasn't down that much either in the bear market in 2022. So they behave very differently than the trend following systems. And that's exactly what we want. For example, during COVID, this particular combination of three systems, this simulation was actually up, which was pleasant, of course. That's not to say that that would repeat itself if we get another pandemic or something like that. But you see, and that's basically the way, because how things are designed, that a lot of those positions started to be in cash already. So 21% CAGR, 21% max drawdown. They're quite okay, I think. But the interesting thing starts when we say, hey, let's start to combine trend following and mean reversion. So we're going to combine 50% to our equity to trend following systems and another 50% to our mean reversion systems. So Now we see that our compounded annual growth rate is at 19%, and our maximum drawdown is at 16.8%. So we're still at one of our larger drawdowns right now. I think it's really within things that you could expect to be normal. Also, because right now, if you see the positions that we are still in, that we are open, you see that there's only a small few positions in the S&P 500 system, which is only for 40% of the time invested. We have only 2 out of the 10 positions of the NASDAQ systems. Then we're actually long agriculture and we're long gold. And then we have a couple of mean reversion long systems on the health sector. But all the other 2 mean reversion long systems and a lot of the trend following stuff is in cash already. So again, for this one, our exposure right now is only at a quarter, you see over here. So less than a quarter is exposed. So we're really protecting our capital right now. And we're waiting. If the market continues like this, we're going to be less exposed. But also, we are, for a certain part, we are exposed on agriculture. We are exposed on gold, for example, which is a nice diversification. We see over here as well that we're down minus 10%. So we still see that in 2008, the system was only down minus 2%, same as in 2022. So I think so far for this combination for long only, getting a 19% compounded annual growth rate, yeah, you have to deal with those drawdowns, but this is still a phenomenal return to risk ratio. However, let's say that you have a retirement account only, but you have next to that, you also have a margin account where you're allowed to short stocks. In the later part of this presentation and this course over here, I will give you 5 systems that are designed to make money in bear markets. Now, what if we would say we're going to trade that suite of those 5 bear market systems? They would have a 6% CAGR and a 30% maximum drawdown. But this is key now. So pay attention to this. So take a look at when it is making the majority of the compounded annual growth rates. 2008, 59%. You see 2011, when the market sold off sharp, 6.6%. 2015, 9% in August. And the 2018 was up 11% for the year versus minus 6. 2022 bear markets plus 11 versus minus 19 for the benchmark. This year, it's up almost 12% year to date, right? So that's 28th of April versus the benchmark that's down minus 6%. And you see as well that during COVID, this system did phenomenally well, of course. So if we take a look at the equity curve, you see, especially over here, bear market starts in 2008, the red line from the index, and the short selling systems and the bear market systems are designed to make money. You see that again during COVID. You see that again during 2015, during the 2022 bear market, and right now in this time period in 2022. Now, I want you to guess what would it be if you could have, for example, let's say $500,000 that you trade with your retirement money, but you'd also have another $500,000 that you actually could trade on the short side if you have that account available. So you cannot trade this in a normal retirement account. I mean, some of the strategies you can, but not all of them. But if you would be able to trade this in two separate accounts, then we suddenly get a 27% compounded annual growth rate and a 13.5% maximum drawdown. So now we suddenly see that every year was up. This year, the system is up year to date, and the volatility is so much lower. It's a very smooth ride when you see those big drops over here. This system only dropped like 12%, 13% or so. So this would be mean a margin account, but what you definitely see is that the magic is that you combine, first of all, different systems. So different long-term trend following systems, 17 and 26. You add then half of it, mean reversion systems, 21 and 21. Then you combine that, you get to 90% CAGR and 16% maximum drawdown. So the mark continues to go up. And you can use all kinds of other statistics if you want to, it's all fine. Then you add a system that doesn't really look that appealing at all, but it's all about when it makes money. And when you combine that to our suite of systems, now you suddenly have a suite of 12 systems that combined have a simulated return of 27% and a maximum drawdown of 13.5%. It's up this year. MAR of 2.03. Now, 7 of those systems are in my book, Trading Retirement Accounts. They're also in this video course, and the other 5 systems are also on the bottom of this video course. I highly recommend you take a look at that. And I hope this gave you a lot of information of the importance of combining multiple systems. So let's see you in the next video.